A bank does not need a vault full of money to create a loan. It needs permission, confidence, and your ignorance. I'm Simon, and today we are opening one of the cleanest exploits in modern finance, fractional reserve banking. Not because it is illegal, that would be too crude. The elegant trick is that it is legal, institutionalized, and wrapped in language so dull that most people's brains politely shut down before the extraction begins. Here is the uncomfortable mechanic. Your deposit is not sitting there waiting for you like a loyal golden retriever. When you place $10,000 in a bank, you think of it as stored money. The bank thinks of it as raw material, a liability on its balance sheet, yes, but also the foundation for creating new credit. It lends, securitizes, reinvests, and multiplies claims on money faster than most citizens multiply excuses for not reading bank disclosures. The exploit begins with a psychological bug. Humans treat bank balances as money, even when the system treats them as promises. Fractional reserve banking works because everyone does not demand their money back at the same time. Your checking account looks liquid. Your neighbor's mortgage looks funded. The business loan looks productive. But beneath the user interface, the system is running a confidence protocol. As long as trust remains online, the machine keeps expanding. Now watch the multiplication. One deposit supports one loan. That loan becomes someone else's deposit, then another loan. This is how credit expands through the banking system. Not by printing physical bills, but by generating new claims on future cash flows. A bank issues a mortgage, the seller receives the funds, those funds enter another account, and the network repeats. The economy sees new purchasing power. Asset sellers see higher bids, borrowers see access, savers see dilution, although usually too late. And here is where the rich stop being romantic and start being precise. Credit creation does not spread evenly. New money enters through specific channels first: mortgages, corporate credit, government debt, institutional finance. Those closest to the credit spigot can purchase assets before the newly created purchasing power fully ripples through the economy. By the time wages catch up, houses, stocks, land, and businesses have already repriced higher. That is not a conspiracy, that is sequencing. The average person experiences this as inflation. The wealthy experience it as asset appreciation. If you own productive assets, credit expansion often raises the nominal value of what you own. If you mainly hold cash and wages, the same expansion quietly makes the future more expensive. This is systemic extraction without a villain twirling a mustache. The design itself performs the transfer, very efficient. Almost no paperwork for the victim. This is why asset prices can rise faster than salaries for decades. The system rewards ownership, not effort alone. A household earning $70,000 may work hard, save diligently, and still watch housing outrun its progress. Meanwhile, the person who owned the house before the credit wave smiles politely and calls it genius. In reality, part of the gain came from liquidity engineering. Cheap credit increases bidding capacity. Higher bidding capacity lifts prices. Higher prices create collateral. More collateral creates more borrowing capacity. The machine does not just multiply money. It multiplies inequality through balance sheets. Banks prefer lending against collateral because collateral reduces apparent risk. But collateral is usually owned by people who already have assets. So the system extends cheaper credit to those who need it least, while charging higher rates to those with less. Observe the elegance. Poverty is priced as risk, and wealth is priced as safety. The algorithm has manners, but no mercy. Now let's examine mortgages, the most socially acceptable form of leverage in the simulation. When banks expand mortgage credit, buyers can bid more for the same houses. The number of bedrooms does not magically increase because credit is cheaper. Supply may remain sluggish while purchasing power expands. Result, prices rise. Existing owners gain equity. New buyers take larger loans. The bank earns interest on a larger principal. The property did nothing, the credit layer changed. That is the fractional reserve exploit in its cleanest domestic costume, a house becoming a financial instrument. The public is told, you are building wealth through home ownership, sometimes true. But the deeper mechanic is that the banking system monetizes your future labor into present purchasing power, then converts that purchasing power into higher asset prices. You feel like you bought a home. The system sees a 30-year cash flow contract secured by shelter. Let's add corporations. They borrow cheaply, buy back shares, acquire competitors, and push valuations upward. When credit is abundant, large companies can finance expansion at attractive terms. Smaller players without the same credit access struggle to compete. Public companies borrow to repurchase their own stock, reducing share count and lifting earnings per share. Investors applaud, executives get compensated. The credit system amplifies ownership returns again. Wage earners may receive a branded mug and a motivational email. This is not capitalism in its textbook costume. This is credit capitalism with a leverage engine attached. The central bank sits above this system, adjusting rates and liquidity like a technician, changing pressure inside a reactor. Lower rates encourage borrowing, higher rates punish excess, but the adjustment never hits everyone equally. Asset owners often benefit first during expansion. Over-leveraged workers and small businesses often suffer first during tightening, same system, different seat location. Here is the dry little joke. The public debates prices. The wealthy study balance sheets. If you only ask, why is everything so expensive? You are analyzing the symptom. If you ask, who received new credit first, at what rate, against which collateral, and used it to buy what, you are finally reading the source code. Prices are the user interface. Credit allocation is the operating system. Now, does this mean banks are evil? No. That would be emotionally satisfying and analytically lazy. Bank credit funds businesses, homes, infrastructure, and growth. A modern economy needs credit. The exploit is not that credit exists. The exploit is that most people are trained to interact with credit as consumers, while the wealthy interact with it as allocators of capital. One group borrows to depreciate, the other borrows to acquire. Bad debt buys status, good debt buys cash flow, equity, or productive capacity. The difference is not moral, it is mathematical. Borrow $50,000 for a luxury vehicle that falls in value and drains cash monthly, and you are feeding the machine. Borrow $50,000 to acquire equipment, inventory, or an asset that produces more than the debt service, and you are using the machine's own rails. Same word, debt, different outcome, extraction or leverage. This is where asymmetric risk enters the frame. The rich design downside before chasing upside. They ask what happens if rates rise, income falls, tenants leave, sales slow, or refinancing disappears. They model survival first. The poor and middle class are often sold monthly payment affordability, which is a much weaker metric. Can I afford the payment is retail thinking. Does the asset survive stress and still compound is capital thinking. The bank does not care whether the loan makes you wealthy. It cares whether the loan gets serviced. That is the brutal neutrality of the system. Your emotions, hopes, and inspirational Pinterest board do not enter the underwriting model. Cash flow does. Collateral does. Credit history does. The machine wants predictable payments. If the asset you buy creates them, you may benefit. If your salary alone carries them, you are the asset. Fractional reserve banking also punishes idle cash in a quiet, almost elegant way. Because credit expansion increases the money supply over time, cash becomes a wasting asset when held too long, not instantly. That would cause panic, slowly, politely. A little purchasing power dissolves each year, like sugar in tea. The saver feels responsible. The system calls it inflation. The asset owner calls it appreciation. Everyone uses different words for the same transfer. So what is the cheat code? Not panic, not rage. Positioning. Understand that the system favors owners of assets, controllers of cash flow, and borrowers who use debt to acquire productive value. It disfavors pure consumers, idle savers, and anyone confusing a bank balance with long-term safety. This is not a command to borrow recklessly. Reckless leverage is just stupidity wearing a tailored suit. The real move is to learn the difference between credit as a weapon and credit as a trap. If you remember one sentence, make it this: money is created as debt, and debt chooses sides. When credit expands, it does not lift all boats equally. It lifts the boats already tied to assets, collateral, and institutional access. If you want to stop being diluted by the system, you must understand where new purchasing power enters, what it reprices, and how to build exposure to productive assets without letting leverage destroy you. The fractional reserve exploit is not hidden because it is secret. It is hidden because it is boring. That is the most effective camouflage in finance. No mask, no vault heist, no dramatic soundtrack, just balance sheets, reserve logic, credit cycles, and millions of people confusing financial literacy with knowing their credit score. The system does not need you enslaved. It only needs you uninformed, emotional, and slightly late. Strategic post-mortem. The banks multiply credit, assets absorb the new purchasing power, owners get richer, and cash holders wonder why discipline feels like running on ice. If this data packet helped patch the vulnerability, subscribe. Like the packet so the algorithm routes it to more humans still mistaking inflation for bad luck. And leave a comment answering this. If new money enters the economy through credit, assets, and collateral first, where are you currently positioned in that sequence?